Wall Street's not that complicated. And it is made to seem complicated to anybody who's not on Wall Street, because creating complexity when it doesn't need to be there is a way of basically retaining power where there is power. I mean, that's really what goes on. And I could be talking about Wall Street for hours today. I don't have hours, particularly right now in this overview, but I want to give you a sense of where that line between why we need public banking or better banking and how it's crossed with private banking and the power relationships that are very much situated in the history of this nation between the elite in Washington and the elite on Wall Street, and in particular through what we now know today as the Big Six banks. The Big Six banks in this country today are J.P. Morgan Chase, Citigroup, Bank of America, Wells Fargo, Goldman Sachs, and Morgan Stanley. Those Big Six banks today, so you know, are derivations for the most part of the same Big Six banks that have been the Big Six banks over most of the last 100 years. So the fact is they've been able to consolidate their power, their money, their influence over a substantial amount of time. And a lot of this is through a combination of relationships with leaders in Washington, as well as relationships with legislators in Congress who also go about making the rules or dismantling the rules that enable these banks to continue to exist and to grow more in concentration in terms of our deposits, our assets, and so forth. So we're dealing with a long history here. Today, these Big Six banks have grown since the financial crisis. So just in the last 7 years, in asset size by 42% in 7 years. Deposits even worse, 82.4%. Their deposit bases have grown in the last 7 years. During that time, their stockpile of cash, i.e. money on their books doing absolutely nothing for the public, has quadrupled in size. Two more numbers. Trading assets, the things that they engage in that have more risk associated with them. These Big Six banks control 96% of all of the trading assets of all of the banks in all of the country. Two banks, Citigroup and J.P. Morgan Chase, control 68% of all of the trading assets in the country. So the concentration here is enormous. In terms of derivatives, which is one complex aspect of these trading assets, their derivatives books of these Big Six banks are 93% of all of the derivatives that are traded in all of the country, and 45% of all of the derivatives that are traded in all of the world. So not only do these institutions, these Big Six banks, hold a tremendous amount of political influence, of power, of capital, they also impose upon us a tremendous amount of risk. And the risk that we experienced in the wake of the subprime crisis, i.e. foreclosures, unemployment rising, wages basically staying the same or declining, all of inequality expanding, all of those factors have occurred towards the general public realm, whereas, as I just mentioned, these Big Six banks have done completely fine. And one of the reasons they've done completely fine and grown is because of their political relationships and because the Federal Reserve, which is our central bank, sort of a private entity that exists in the core of Washington, was initiated back in 1913 to help the largest banks in their times of trouble. A lot of narratives around it, which I won't get into right now, have grown to talk about the Federal Reserve's role in creating employment and all sorts of other things. But the reality is their role was to create liquidity, to provide the fluidity, the money, the capital for big banks who were initiators of the Federal Reserve to maintain their stability in times of trouble. And that has happened many times throughout the last 100 years, in particular in the wake of the subprime crisis of 2008. So they created a tremendous amount of risk. They were facing losses of a tremendous amount of money and a tremendous amount of power, and the result of which was a tremendous call on the Federal Reserve and on politicians and on the White Houses under both parties, under both Bush and Obama. So this is not, the big banks grow regardless of who's in power and what party they come from. And they do this by amassing public funds, by amassing capital that could be used instead to help the public grow, to help small businesses, to help infrastructure, to help wages increase, and all sorts of other ways that which capital can be used. And instead what they are doing is growing their derivatives books and growing their trading assets books and going internationally and expanding in such a manner that they are making profits outside of the country that don't go into the country, outside of states that don't go into states, lending in ways that don't facilitate more economic stability in this country or in any one state. And they're doing this with complete support of government policy. And so a way to step back from that, a way to step back from the major concentration of power and risk and capital that these banks have amassed throughout this last century, is to find ways to divert that money, is to find ways to come, and we'll be talking about this all day today, but ways to segment all of this tremendous concentration of power and capital, deposits and assets into local community and other types of banks that can effectively work with what is required from their public constituents. So whether that is funding small businesses, whether that's helping to renegotiate loans, which big banks don't tend to do with individuals because they don't need to. If you're having so much help and so much money thrown at you, why bother? That's what we've seen. On a public level, on a local level, on a state level, the idea is to take money, to take capital, to take it away from these private institutions, and not just private institutions, but these in particular concentrated institutions, these monopolistic group of 6 banks and banks that they work with at that level, and bring it back to working for the country, to working for people, to working for states, to working for communities, to working for businesses that can grow from the ground up rather than wait around for some sort of trickle down that doesn't happen from the top of these banks and this political financial infrastructure down. And I think that's what we're really here to talk about today is why we need it, because of this risk, because of this power, because this capital that isn't helping us on the ground to the extent that it can, to the extent it should. Big banks knew how to argue over these 100 years for their share. They have a really big share. They've argued really, really well. And what we're going to do and what we need to do is argue that, you know what, we need our share too, and we're going to grow here. Because that's what we need to do to stabilize all the local economies, state economies, individual financial stability, and so forth down the road. So I'm excited about listening to what everyone else has to say today. We're gonna be having questions and everything else throughout the day. But that's really what it comes down to. You know, how do we stabilize our control over how money gets used in this country so that it doesn't get used for purposes that don't benefit the country or the state or the local areas or individuals. So with that, I am going to thank you for listening and turn it over to whoever comes up here next. Thank you.